There is a product that exists in your wallet right now that was designed from the very first moment of its conception, not to help you, not to give you financial freedom, not to make your life easier, but to trap you, to keep you paying forever. And the people who designed it knew exactly what they were doing. But that's not the crazy part. The crazy part is that this product is completely legal. The people who designed it have never been arrested. The executives who refined the trapping mechanisms, who hired psychologists and behavioral scientists to make the trap more effective, who tested and optimized every single element to maximize the amount of money extracted from the people least able to pay it, those people received bonuses. Large ones. The crazy part is that the trap was not designed for wealthy people. It was designed specifically, deliberately, and with extraordinary sophistication for people who were already struggling. People who were one missed paycheck away from disaster. People who needed money they didn't have and had nowhere else to turn. The poorer you were, the more valuable you were to the system. Not because you could afford to pay back what you borrowed, but because you couldn't. And the craziest part of all, the internal documents exist. The memos are real. The emails were subpoenaed. The behavioral research was conducted. The predatory architecture was designed in offices by people with business degrees and performance targets and families they went home to every night. And almost none of them have ever faced any consequence for what they built. By the end of this video, you're going to understand exactly how the credit card industry transformed a simple lending product into the most sophisticated debt trap ever created. How they used psychology, mathematics, and regulatory capture to keep hundreds of millions of people paying interest forever. And how the people who designed the system protected themselves from any accountability while extracting trillions from the poorest households in America. This is the story of the credit card industry, and it starts not with greed, but with a genuinely useful idea. The original concept of the credit card was simple and legitimate. Instead of carrying cash, you could carry a card that represented a line of credit from a bank. You would use the card to make purchases. At the end of the month, you would receive a statement. You would pay the full balance. The bank would charge the merchant a small fee for the convenience. Everyone would benefit. The consumer got convenience. The merchant got faster sales. The bank got a small fee. This model worked for about 15 years, from the late 1950s through the early 1970s. Credit cards operated more or less as designed. Most cardholders paid their balances in full each month. The banks made modest fees. The product was genuinely useful. Then something changed, and the change did not come from technology or innovation or market forces. It came from a single Supreme Court decision in 1978 that the credit card industry recognized immediately as the most valuable gift it had ever received. The case was called Marquette National Bank versus First Omaha Service Corporation. The question before the court was simple. When a bank based in one state lends money to a customer in another state, which state's interest rate limits apply? The court ruled that the bank's home state interest rate limits applied, not the borrower's home state. The implications were immediate and enormous. In 1978, most states had usury laws that capped the interest rate a lender could charge. These laws existed specifically to protect borrowers from predatory lending. They were often set at between 10 and 18%. But if a bank could simply relocate to a state with no usury limits, it could charge any interest rate it wanted to customers anywhere in the country. Within months of the Marquette decision, Citibank, which was struggling with the inflationary environment of the late 1970s, made a deal with the state of South Dakota. South Dakota had no usury laws. Citibank would move its credit card operations to South Dakota, bringing thousands of jobs. In exchange, South Dakota would guarantee that it would never impose interest rate limits on credit card lending. Delaware made a similar deal shortly after. Then other states competed for banking business by eliminating their own usury protections. Within a decade, the interest rate limits that had protected American borrowers from predatory lending were effectively disappeared. Then other states competed for banking business by eliminating their own usury protections. Within a decade, the interest rate limits that had protected American borrowers from predatory lending had effectively been abolished. And the credit card industry would never be the same. It could continue operating as a convenience product for relatively affluent consumers who paid their balances monthly. or it could transform itself into a lending product targeted at people who would carry balances month to month, paying interest indefinitely. The math was not complicated. A customer who paid their balance in full every month generated modest fee income. A customer who carried a balance at 24% interest and made only minimum payments was worth orders of magnitude more. The industry chose the second path, and they pursued it with extraordinary sophistication. The first tool was the minimum payment. In the 1970s, credit card minimum payments were typically set at 5% of the outstanding balance. This was not generosity, it was mathematics. At 5% minimum payments, a customer carrying a balance would pay it off in a few years and pay a moderate amount of interest. But industry researchers discovered that lower minimum payments dramatically increased the amount of interest collected over time. By the 1990s, minimum payments had been reduced to 2% of the outstanding balance at most major issuers. At 2% minimum payments on a typical credit card balance, a consumer could spend decades paying interest before eliminating the principal. The second tool was the credit limit increase. Banks discovered that consumers who received unsolicited credit limit increases almost always used them. The psychological effect of a higher limit was to make the debt feel more manageable, more abstract. A consumer carrying $5,000 in debt on a $10,000 limit felt more stressed than the same consumer carrying $8,000 in debt on a $20,000 limit, even though the second consumer was in a worse financial position. Banks began routinely and automatically increasing credit limits for consumers who were carrying balances, not as a reward for good behavior, but as a tool for encouraging more borrowing. The third tool was the penalty fee structure. Late fees, over-limit fees, cash advance fees, foreign transaction fees. In the 1980s, penalty fees were modest and relatively rare. By the early 2000s, they had become a major profit center. A single late payment could trigger a late fee of $35, a penalty interest rate increase to 29%, and the loss of any promotional rate the consumer had been receiving. The penalty structure was designed to be triggered as often as possible, which is why due dates were set at inconvenient times, statements were mailed late, and payment processing was deliberately slow. The fourth tool was the Universal Default Clause. Under this clause, if a consumer was late on any debt anywhere, not just their credit card, but any debt, a mortgage payment, a car loan, even a library fine, the credit card company could immediately raise their interest rate to the maximum penalty rate. This clause was buried in the fine print of cardholder agreements that ran to dozens of pages of legal language that almost no consumer read or could fully understand. The fifth and most sophisticated tool was the behavioral targeting system. By the 1990s, the major credit card companies had accumulated extraordinary amounts of data about consumer behavior. They knew which consumers were most likely to carry balances. They knew which consumers were most vulnerable to financial stress. They knew which marketing messages were most effective at convincing people to open new accounts or increase their borrowing. A 2008 investigation by the Senate Permanent Subcommittee on Investigations revealed internal industry documents showing that credit card companies explicitly targeted low-income and financially stressed consumers for their most aggressive marketing. One internal document referred to these consumers as revolvers, meaning customers who would revolve their balances month to month and generate maximum interest income. Another document described the ideal target as a consumer with high credit utilization, meaning someone already carrying significant debt relative to their limits, because such consumers were most likely to continue borrowing and least likely to pay off their balances. The industry also discovered and exploited what behavioral economists call present bias. Human beings systematically overvalue immediate rewards and undervalue future costs. A credit card that offers you something you want right now at a cost you will pay later in small monthly installments is perfectly designed to exploit present bias. The pleasure of the purchase is immediate and concrete. The pain of the debt is deferred and abstract. The industry spent billions on research to understand and maximize this psychological dynamic. They discovered that round numbers on credit limits, like $5,000 or $10,000, felt more like money in the bank than like debt capacity. They discovered that reward programs, points and miles and cashback offers, made consumers feel like they were getting something for free, even when the interest they were paying far exceeded the value of the rewards. They discovered that the physical act of swiping a card rather than handing over cash reduced the psychological pain of spending by as much as 50%, which is why they pushed hard for the adoption of card payments at every possible merchant. By the early 2000s, the average American household was carrying over $8,000 in credit card debt. The credit card industry was generating over $30 billion in fee and interest income annually, and the distribution of that income was deeply revealing about who the system was really designed to serve. Analysis of industry data showed that approximately 70% of credit card industry profits came from consumers who carried balances month to month. These were disproportionately lower-income consumers, consumers with less financial education, consumers under financial stress. The affluent consumers who used credit cards for the convenience and rewards and paid their balances monthly were actually subsidized by the banking system. Their rewards points and cashback offers were funded by the interest payments of poorer consumers who couldn't afford to pay off their balances. The system was, in other words, a transfer mechanism. It took money from poor people and gave it to rich people in the form of airline miles and hotel points and cashback rewards, and it charged the poor people an extraordinary fee for the privilege of funding the rich people's travel. The response from regulators was slow, inadequate, and ultimately incomplete. For decades, consumer advocates had been raising alarms about predatory credit card practices. The industry had responded with lobbying, with campaign contributions, with the revolving door of regulators who moved into well-paid industry jobs after leaving government service. And the behavioral targeting of financially vulnerable consumers could continue as long as it was technically compliant with the new disclosure requirements. The industry spent over $600 million lobbying against the 2009 reforms. When the reforms passed, it spent hundreds of millions more finding ways to comply with the letter of the new rules, while circumventing their spirit. Within months of the law taking effect, banks had introduced new fees that replaced the revenue from eliminated fees. The trap had been modified but not dismantled. Today, the American credit card industry generates over $150 billion in revenue annually. The average interest rate on credit cards carrying balances has increased to over 22%, the highest level ever recorded. Low-income consumers, the consumers the system was most carefully designed to capture, pay effective interest rates that are often far higher when all fees are included. No credit card executive has ever gone to prison for designing a product to trap poor people in debt. No credit card company has ever been forced to refund the interest collected through practices that were legal at the time, but were designed to exploit psychological vulnerabilities. The executives who built the system, who wrote the memos and designed the algorithms and hired the behavioral scientists, retired with extraordinary wealth. The consumers who were trapped in the system, who paid 22% interest for decades on debt they could never quite eliminate, who had their interest rates raised when they were most vulnerable, who were targeted precisely because they were least equipped to resist, received a disclosure notice in slightly larger font, and a federal law that addressed the most visible abuses while leaving the fundamental trap intact. There is a credit card in your wallet right now, or in your drawer, or in your history, and the people who designed it knew more about your psychology, your financial behavior, your vulnerabilities, and your biases than you will ever know about yourself. They spent billions of dollars learning exactly how to make you borrow more and pay less of it back, and feel somehow like you were getting a good deal. That is not an accident. That is not a side effect. That is the product. If you believe the public deserves to know where the money actually goes, subscribe. Every week we cover the frauds, the scandals, and the financial crimes the system would rather you forget.